Well, I think they tell us pretty clearly the direction of travel. We've seen the economy doing reasonably well in the first half of the year, though due to some transitory factors, partly it's a big inventory accumulation, which we think will fade, and partly it's a pent-up demand effect boosting household consumption of services. But beyond that, the outlook looks pretty bleak. I mean, you've mentioned yourself the potential constraints on energy supply. But also, when you look across most indicators of sentiment, they're either already weak or heading in a downward direction. Consumer confidence is at record lows, lower even than we saw at the height of the global financial crisis and in the first wave of the COVID shock. We're seeing industrial confidence weakening, including in our own PMI numbers, and we're seeing confidence even in the service sector now weakening. And I think the key point to stress there is we're now in the height of the summer tourist season. If it wasn't for that consumer demand for tourism and recreation related services, these indicators would be telling us the outlook is even weaker still. So as we move beyond that period of pent-up demand, as we head towards the latter part of this year and early next year, I think it looks inevitable that the euro area is headed for a recession. The question is only how deep it will be and how long it will last.
Do you have a sense, based on the survey data, how deep it will be and how long it will last?
Well, so far it looks like it's going to be relatively mild. And there are a few factors that are supporting that. One is that monetary policy, although it's tightening, still remains relatively accommodative in the euro area. So that's a big difference from what we see in the US, where obviously the Federal Reserve is telling us that it wants to take rates into restrictive territory and slow the economy down, cool the labor market. So that's one factor which, at least for the time being, is less of a constraint. But I think the problem here is that the headwinds are building. So we have a particular issue, acute issue to do with energy supply. We've seen in the last couple of days, the gas price has soared again. Looks like a perfect storm of factors leading to upward pressure on the gas price. And so as we move towards this, to the seasonal effects, when demand goes up because of cold weather, household demand as well as industrial demand, then clearly we're going to hit the biting point. So I think the risk is, for now, at least according to the PMI data, it looks like the economy is just below the expansion level. As we go into the winter, those energy shortages will bite, confidence will be weaker, we'll probably see somewhat tighter monetary conditions by then as well. So the risk here is that we get a very abrupt shock to the economy, and the recession could end up being a lot deeper, potentially around the turn of the year, than the survey data is suggesting at this point.
Kenneth, looking through the Eurozone survey report, there is one potential bright spot that sticks out to me with regards to inflation, and I'm keen to hear you provide some more detail here if you can. Although remaining elevated, there were again signs that inflationary pressures at businesses have passed their peak. When it comes to the ECB, part of the reason that we saw this sell-off in markets yesterday was because the German Bundesbank president said that he thinks that more interest rate hikes are going to be needed to control inflation. If we are seeing signs that inflation pressures are peaking, perhaps that paves the way for a less aggressive ECB, or gives them a little bit of breathing room on rates.
Yeah, that's an important point. I'd separate two issues here. First is what's going to happen in the immediate future. The ECB is way behind the curve. Inflation is exceptionally elevated, likely to remain that way at least for the next several months. And as a consequence, the ECB has some catching up to do. So at the next meeting, the ECB will deliver at least a 50 basis point increase in rates, and probably at the October and December meetings, at least 25 basis point increases, possibly more, because we're in the phase now where policy rates look way too low given the inflation backdrop, and they have to make an adjustment. The bigger issue is whether interest rates go into restrictive territory and the ECB starts to panic about the need to keep inflation expectations anchored, worries a little about the impact of the weaker euro through imported prices pushing up again on inflation. We think probably the ECB will not go there. The guidance currently suggests that they will move interest rates back towards a neutral stance. We think that's a reasonable assumption given our expectation of a recession in the euro area starting in the fourth quarter. And also this evidence that's building that pipeline price pressures or upstream price pressures for goods are beginning to diminish. And we've seen this in the PMI data for a few months now. So looking at the manufacturing numbers, input prices, they peaked back in late 2021 Output prices have been coming down over the last 3 or 4 months. So we are beginning to see signs that those pressures are diminishing. And I think the likelihood is that goods inflation will turn down pretty quickly as we move into next year. We're seeing this also in our indicators of material prices, industrial commodities. That index that we create has fallen now 4 months in a row, and the year-on-year rate of change has turned negative for the first time in a couple of years. So it looks as if those goods pressures, which have been a key part of the story in pushing inflation higher, are moderating. But at the same time, we've got an energy shock that's still ongoing, have high levels of food price inflation. And of course, the service sector rates are being boosted by this pent-up demand. So it's going to be a while yet before we see clear evidence that inflation is slowing. But I think if you take a forward-looking view, then those goods price pressures do look like they're diminishing, and that does reduce the likelihood that the ECB will follow the Fed into restrictive territory.